Hey guys, how's it going? Welcome back to the YouTube. I have received quite a few questions from my last recording on NFP when I mentioned slippage of how the slippage is working. I did indeed mention that slippage is going to be causing a lot of risk to your trades, and of course, when you're having the news event, you want to avoid it to avoid the risk of slippage. So, after receiving quite a few questions of how the slippage is working, and some more detailed explanation on it, I decided to make a brief recording and explain some details here. So, what is slippage and how is it going to be working? Slippage, as a brief statement, slippage is requesting a market execution at a certain price when you're pressing the button and getting the trade executed at a different price when the trade actually gets executed. So is the difference between the actual price you're expecting to execute the trade on instead of the actual price the market fills your order in. So that happens a few times, of course. It's definitely experienced, especially if you ever traded a live account, not just the prop firm demo accounts, because mostly anything that's a prop trading evaluation, you will not really face any slippage due to the nature of the demo nature of the account. However, if you're trading anything that's a live trading account, you of course probably experience slippage at some time in your career. So let's see some details here and some further explanation of what this is. Whenever you're trading and whenever you're executing a position, any type of order you're placing, there's a counterparty on the other side every single time. If you would be buying a one lot position at a given moment, on the other side, there's going to be a counterparty every time who's selling one lot trading volume at that given moment, probably at the same time, and your position is technically having a counterparty against it, because that's of course how the over the counter market is working. So the OTC market, which is the standard nature of the forex industry, is you're having a counterparty against you, and you shall imagine the market as each of the price levels are executed by different traders with different trading volumes in terms of different type of lot sizes. And in normal cases, when you're not having any type of slippage, when you press the button to execute a position, your trade is connected to a different counterparty, or the other counterparty is taking a selling position at the same time with the same volume, of course. And if it happens to be the same volume, and your position happens to be having a valid counterparty on this other side who the order can be filled against, in your trade is going to be accepted at the requested price, and of course your trade is not going to be facing any sort of slippage, because the counterparty on the other side is of course going to be filling in the trade against you on the same price level. So, technically imagine when you're selling, someone else is buying the same trade at the same price. So in that case, if that happens, there won't be any sort of slippage. And in other cases, when you're facing a slippage, the way that would happen is, if you request the order at a given price, let's say a 10 lot buying position, and if there isn't enough counterparty on the other side to cover the position to compensate the position on the selling side, of course, your order isn't going to be executed at your own requested market price. So, that being said, of course, if someone is having a 10 lot position at a different price, it is going to be executed more on the different price and the difference between the average ratio of those two prices. So, Let's just take an illustrative example of this, of how this is going to be working. Alright, so now that we are here on TradingView, let's just take an illustrative example of how the non-slippage market situation would be working. So let's imagine a situation where you would be expecting to take a buying position at a certain price in the market with a one lot position, and if that's the case, and at that given moment there's also another counterparty on the other side who's selling a one lot position, your trade is of course going to be executed at the same price in the market as you were expecting to be executing the trade at. So technically there won't be any slippage, and the counterparty who's also selling one lot position, when you're taking that buying trade that is one lot position, their counterparty is matched and you're not facing any slippage. But let's suppose things would be a bit different, and let's say you would be opening a much higher volume position with a 7 lot trade, and let's say there's a different 7 lot order at a different price, but there wouldn't be any sort of volumes on the prices in between. Your order is of course going to be accepted at a worse price, because let's suppose a different selling position is going to be at a different price in the market. The same order has to be matched up with a different counterparty, and in that case your trade is going to be affected with the slippage, because your original requested market price is just not going to be accepted at the requested price, and of course that is creating the slippage that you're facing on a trade. So let's take this as a another example here. Suppose that the order that you're placing is going to be having a 7 loss position, and at your requested market price, the counterparty that the market is finding against you is only going to be a 1 lot position. Of course, if that's the case, the 7 lot order cannot be executed at the initial requested price either, and if at a different price level the market isn't going to be having any sort of 7 lot position either. So while on the previous example we had a 7 lot position on a different price level at a counterparty, if that wouldn't be the case, that none of the recent other prices is matching up your order, the trade is going to be of course automatically split up into multiple positions, and your trade is going to be filling the possible values, of course, of the possible counterparties, and each of the volumes that's available as a point of liquidity. So any of the available counterparties is of course going to be used up by your position, and an average value of this position is going to be the result of the slippage. So in that case, because the market wasn't finding any sort of other counterparty at any given price, the position is going to be split up into different pieces, and that would be resulting in an average number of these positions and the average value of the price, creating an execution price of a different price once again. So in this case, there would have been a 1.8 pip slippage with this example, but once again it does show how the order will be matching up the slippage, and how the order will be matching up your price with a different trader's counterparty's order. So that of course is creating the slippage. And how is this tying all the way back to that other NFP example that I spoke of last week or in the last meeting? Is whenever you're having a position, let's say on the news event, you're going to be facing the slippage issues because the market just isn't able to find enough liquidity at the requested market price on a counterparty against your trade. So that being said, of course, your position is going to be split up into multiple orders and executed at the available other prices. And as a quick summary, how would this be affecting your trades in real time, and how do you manage this? Well, there's a couple of ways to manage it, and of course it kind of depends first in the first place. Like, are you trading a demo evaluation on a prop trading firm, or are you trading on a live account with a brokerage? What you gotta know is evaluation firms challenges are of course going to be done on a demo account, so you're not even facing any problems with slippage, and you shouldn't be facing any problems. Like, some very low tier companies, I do know they do have some artificial slippage, but in a demo environment you should not be having any sort of slippage in the first place. So on the evaluation or the challenge, you're not even having any problems with this. But how do you manage this if you're trading a live account? Because of course on a live account you would be placed in a real environment. And before I speak of some details of the live account, understanding that if you're actually trading on a prop firm that's giving you funding, this also bears the question that, okay, if you're trading on a demo account and the company that's copying your trades to give you funding, if they are copying your trades to their own live account, if they face slippage on their positions, but you do not face slippage because you're executing on a demo account, that can kind of affect your trade. So, in that case, you might want to reconsider probably not trading on high impact news events, because that also does answer the question why some companies do not allow the news trading. Because of course, if you're taking a position on a demo account and on a news event, you're not facing any slippage. But as the company is copying your trades, they might be facing slippage on the live markets, because like I mentioned, slippage is indeed a natural process of the market in some certain cases. So you gotta avoid news trading events to save yourself from this. And of course, if you're getting funded, it's just completely bad for the funding firm to have trades that are affected by the slippage, because of course they are not getting the same positions as you're getting on your demo account. So just kind of try to avoid it. So that's the prop trading side. And as a quick summary, so on the prop trading side, the client doesn't really face any problems with it because it's a demo, but if the company is copying your trades, they might have to deal with it. So on the live account side, let's say you're having a live account, absolutely your own personal funds, your own personal trading account with a brokerage. If the broker is B-booking you, which I can absolutely tell you a good 90% of the brokerages, they are indeed going to be B-booking you, because that's what the 90% of the brokerage industry is. It is just simply running traders on a B-book. A very few companies on the brokerage industry, they do A-book everything. The broker I'm using is A-book. Otherwise, if you're making long-term profits, you're kind of facing issues with a B-book broker, because they always try to mess with your trades. So in that case, you might not be facing any problems with it, but like I mentioned, you might be having some artificial slippage. But if you're having an A-book brokerage, like a full-on A-book broker that's absolutely sending all of your trades to the real markets, which you should be using if you're, of course, serious in your trading. So if you're using an A-book brokerage, you should try to avoid trading like absolutely too big trading volumes. Like, we are speaking of 100 lot or hundreds of lots or 1,000 lots. So obviously it's a pretty extreme example, and you do need a substantial capital to reach that position sizing to even face a problem with this. But even with smaller positions, like if you're having a 10 lot position, very often, if you just want to make sure that your position is getting executed at the best possible prices, if you're opening a 10 lot volume position, it's sometimes better to be layering those trades into like 10 pieces of 1 lot positions. So it's also possible to layer some of your positions. That way you would be facing less of a slippage. But the higher the volume you go, the higher volume you're using in your trades, the more it's kind of possible to have some slippage. And and on the other hand, most brokers actually they do limit the lot sizes. So if they limit your lot sizes to maximum 200 lots or 200 lots, for example, as the max volume, like that's also limited for the purpose to avoid too much slippage on the client side. So it's working that way. And as the solution, you just kind of gotta make sure to open multiple smaller positions instead of one massive trade. So let's say not opening 100 lot trade, you would be opening like 5 20 lot trades, for example, and it does indeed layer some of those positions into a much better market pricing.